The U.S. is importing less oil than it has in a generation thanks to booming shale production along with more efficient cars and appliances. The percentage of domestic oil consumption that comes from domestic sources above 80%, certainly a huge recovery from when it was 69% in 2005. But question is, can we ever become truly energy independent? Tim Gramatovich is the chief investment officer and co-founder of Peritus Asset Management. He manages the firm's high-yield ETF, which invests heavily in oil and energy. And of course, we'll get to that in a moment. But Tim, you say that this idea that the U.S. can be energy independent is a fantasy. Explain.
Yeah. Hey, guys. Happy early New Year to everybody.
Happy New Year.
Yeah, I think you've got your math wrong, and I think that people are constrained as it relates to the real numbers. I mean, we're consuming about 19 million barrels a day, and we're producing about 9. And so I think that there's a little bit of kind of reality that needs to be injected into this.
So what the reality, tell us a little bit more about the reality here, because we hear about how there's an oil glut and we are producing all this oil and Saudi Arabia putting its hands up and saying, go ahead, let's see what happens with the market.
Yeah, and I think that let's put things into perspective, guys. I think that the first thing is that you're talking about a market that probably is out of balance by about 2%, and you've seen oil prices come down 55%. So unless you're telling me that demand is about to collapse, which I don't believe, actually demand was growing at $100 a barrel. It's certainly going to grow faster at $55 a barrel. Then, you've got the makings of a bottoming. Yet nobody knows where it's going to go. It could go to $30, $40. But I can tell you it's unsustainable. It's probably unsustainable below 80 or 85 bucks because, most of the growth in production globally is all unconventional. And whether it's shale, whether it's deep water, whether it's oil sands, it requires a certain price point. And I'll tell you that the reason that the shale business got going was twofold. First, you had to have cheap capital, and then you had to have very high prices. And you don't have either of those today. So I think we're going to see a pretty big shift in terms of both production numbers and the sustainability of U.S. shale production.
Tim, tell us about what's going on in Canada right now with oil prices, where they are, and what this means for the Canadian oil sands project.
Yeah, again, a little bit of a misnomer, Pimm, from the standpoint of there are two things. First of all, Western Canada has, production, obviously has conventional production. It has tight oil production like the U.S. Then it has oil sands. And oil sands is sort of in two flavors. One is mining, and the other one is SAGD, or steam-assisted drainage. And so what you have is that you have projects that have been built that are producing. These are long live production assets, Pimm, and these things are going to produce for 30, 40 years, which is obviously the attraction. And the other thing that you get from a Canadian perspective is you get you get the lower C dollar. Right. So these guys have costs in Canadian dollars and they're receiving, U.S. dollars for their production. One final point on that is that the majority of that is heavy oil production, which is what is required by the Gulf. Right. All of those refineries in the Gulf Coast are looking for heavy. And we're producing a ton of condensate and superlight oil in the Eagle Ford. And that's why we need to ship that stuff out or use it as a blending stock. So it's a complicated market.
Okay, so you, I know, have moved to take advantage of this drop in oil prices and invest in some Canadian assets. In terms of credit, oil credit, energy credit, you also own Conacher bonds. Prices of its bonds maturing in 2019 have been falling sharply, so of course that pushes the yields up. And currently, the yield on the Conacher that matures in 2019 is at 38%. Liquidity in the high-yield credit market has been a big concern of late. How difficult would it be to get out of this trade?
Well, again, we own a lot of things. I think we own very, very little of Conacher. But Conacher is really a distressed project, all right, from the standpoint of a restructuring process, and we think it's a very interesting opportunity. But that's not really the focus of what we're talking about. So, for our portfolios, what we're looking at is both on the high yield bond side, the loan side, and then even on some of the dividend equities. Outside of that, what you have is very, very low leverage, very, very different than the shale business. And I think so from our perspective, we view these as sustainable models. But guys, I want to talk one thing, and it's very, very, very important for everybody to understand. And that is that the key to this stuff and why this shale stuff is a falling knife in the high yield market, and we own none of it, and we are not going to own any of it, is because that when you drill a well, and I don't care if it's in the Bakken, I don't care if it's in the Eagle Ford or the Permian, these shale wells decline at 65 to 70% in the first year. Those aren't businesses. They are projects. And that's why we don't play.
And
in some cases, you've got these wells already drilled, right? I mean, the production from those wells to support the payments on the bonds are already there. They need to drill up that much more to continue to make those payments.
Cory, that's the problem, right? You're on a treadmill. And this is the thing that nobody understands. I think you're going to be very surprised. You're going to see a very limited M&A cycle in the U.S. And the reason being is that the guys who own the best acreage, and you can go through the list, and that's a Continental, that's an EOG, maybe that's an Anadarko. These guys are well capitalized. They have the best acreage. And these are positions for them in a much more robust portfolio of assets. It's not their only business. The guys who came late to this business, who financed this stuff in the high yield market, okay, levered these things up, these things are going to lose. And the problem is that who's going to buy them? You know, at the end of the day, you know, the well-capitalized players have their acreage. These guys came late. It's not the best acreage. And even the distressed guys who are taking a look at this stuff are recognizing that at the end of the day, there is no free cash flow because of the treadmill. When you have to drill, you know, and drill and drill and drill, because again, 70% declines. That's the issue. That's the problem. You never ever make that up. So that's why we stay away from that stuff.
Interesting.
Okay, so you call it a project, not a business, these shale operations. Did you foresee the drop in price that we've seen?
No, I mean, and again, I don't think anybody did. Let me tell you my perspective on this. First of all, it is unsustainable, and I don't care where it bottoms. But my take is a bit different. My take is that what you see happening is that the Saudis' market share in Asia is really what we're dealing with. So Nigeria was producing, you know, Nigeria produces around 2 million barrels of crude oil a day. That crude oil was coming to the U.S. Now, of course, we've displaced that crude oil, so Nigeria has to find a place for it. Where are they going? They're going to Asia. So as that goes to Asia, that starts to worry, you know, the Saudis and their market share. And guys, I will tell you one thing, and this is the other thing, is that 5 million barrels a day is being produced by 3 very tenuous countries: Libya, Venezuela, and Nigeria. And that production, along with the Russian production today with prices, is all very much at risk.
All right. Tim Gramatovich, thank you for providing us some context here. He says the idea of U.S. achieving energy independence is a fantasy.